Hi and welcome to this calculation exercise. We will today calculate return on a board game. And prior to this video, I recommend you to see Portfolio Theory 2 as well as Investment Decision Rules 2. And now please pause the video and read the question.
Hi and welcome back for a new calculation exercise for Finance 1. My name is Anders and now we will evaluate a board game or the effective rate of return that we have received owning this board game. We know from the question that we bought it for 50 and we had to buy a bus ticket for 50, hence it costed us 100 kroner or dollars or whatever. We also know that we have received a lot of joy of playing this game. We said that the joy can be valued as 80 for every year in 17 years, received in the end of every year. We also know that we can sell it after 17 years for 1500. I will now wonder what is the present value, what is the effective rate of return on this investment? Well, the effective rate of return, or the IRR, can be calculated by finding the interest rate that gives us a present value or a net present value of 0. Hence, when the present value of all the cash flows we receive is equally large as the present value of the cash flows we pay. In this case, we only pay 100 in the start, and then we only receive cash flows, so it's a bit easier. But we can conclude that the net present value would be the initial outlay, which is minus 100, plus the present value of the annuity of 80s, and then we use this formula, so plus 80 times 1 divided by r times 1 minus 1 divided by 1 plus r raised to 17 in our case. And the money we get when you sell it after 17 years. And then we use this formula since it's only one cash flow. So 1500 divided by 1 plus r raised to 17, since it's 17 years until we sell it. So when this expression is equal to 0, we have found the internal rate of return. As you know, the internal rate of return is found by guessing. So then we better guess smart, because otherwise it might take a long time to find it. But we can, if we just look at the cash flows, we invest 100, and the first year we get 80, and then we get 80 for every year in 17 years. And in 17 years we also receive the 1500. So I mean, in 2 years we have obviously get more in present value terms than the investment using a regular interest rate. So in order for this net present value to be 0, we have to use a very high interest rate. So let's start with something extreme. Let's say 50%. So then we get NPV, or net present value, is equal to minus 100 plus 80 times 1 divided by 0.5 for 50%, times 1 minus 1 divided by 1 plus 0.5 raised to 17, plus, actually I can fit it here I think, plus 1500 divided by 1 plus 0.5 raised to 17. So now if we type this into the calculator, we get that the net present value is approximately 61.35. Obviously 61.35 is not 0, so we have to continue to guess. And we also know that when the net present value is positive, we have to increase the rate of return. And that is because we need to discount the cash flows with a higher interest rate, hence value them less in present value terms, in order to receive the net present value of 0. So then, why don't guess with 100%? Even more extreme. So if we use 100% interest rate, we get minus 100 plus, and well, of course the same thing here, but we change this here to 1 actually, because it's 100%. 1 minus 1 divided by 1 plus the interest rate, 100%, which is 1, raised to 17, plus 1,500 divided by 1 plus 1 raised to 17. And if we type this in the calculator, we will get a net present value of minus 19.98. So now we have received a negative net present value. And that means that we have to guess on a lower interest rate. Because now we're discounting the cash flows too hard. We are evaluating them too less in today's term. So we have to guess something between 100 and 50, or between 50 and 100. We can see though that it looks like we are closer to 100 than 50, since the deviation from 0 is smaller in this case than in the first case. So we might guess on 80. And then we do the same thing. Minus 100 plus 80 times 1 divided by the interest rate, 80%, times 1 minus 1 divided by 1 plus 0.8 raised to 17, plus 1,500 divided by 1 plus 0.8 raised to 17, which happens to be approximately 0, or more precise 0.064. And now if we guess on 81%, we will see that the deviation from 0 is larger when we use 81% than 80%. So since we should round the answer to whole percentage points, 80% annual rate of return would be the correct answer. And yes, that was all for today. Thank you very much.